The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and welcome to Your Money, Your Call. I'm Margaret Lomas and it's great to be back again this week. My two guests this evening are Michael Teys from Teys and also Brad Beer from BMT. And so we have an awful lot to get through this week. As usual, when I have those two guests on, we get a lot of calls and I hope that you'll join us this evening with your special questions. Anything to do with strata, anything to do with depreciation, and of course anything to do with investing in property at all. We're here to answer your questions. But let's start with this week's news. And Australia's established housing market remains strong overall, according to the Reserve Bank of Australia. The time taken to sell properties and the average size of vendor discounts are at low levels, and auction clearance rates are above average, albeit not as high as late last year, the bank's latest statement of monetary policy advised. Stock turnover appears to have increased a bit in the June quarter, though is still a little below average. The RBA noted the nationwide rental vacancy rate has been little changed over recent quarters and at a relatively low level. And with last week's decision to keep rates on hold coming as a little surprise, industry groups are now turning their attention to banks and lenders. Over the past fortnight, 71 home loans with a 5-year fixed rate term have had their interest rates cut by up to 0.8%. According to Rate City. Unsurprisingly, this is becoming of greater interest to borrowers as lenders increasingly move out of the RBA cycle that has been stable for 12 months now at 2.5%. Despite much of the RBA talk discussing the next potential increase, most industry members wholeheartedly agree that we've now hit the trough, despite disagreements about when we're going to see a rise. Responses yesterday to the next month of stability mirrored 1,300 home loan sentiments. And more cuts are coming, not necessarily from the RBA, but from lenders. With me tonight to discuss these stories and answer your questions, as I said, is Michael Teys from Teys Lawyers and Brad Beer from BMT. So if you have a question for any of us, you can call us right now on 1300 30 34 35 or email it to property@skynews.com.au. Welcome to the program. Welcome
Good evening, Margaret.
Michael, I can't let the beginning of the show go by without recognising your recent English Channel victory.
Thank you.
You've just swum the English Channel in a pretty good time of 11 hours and 22 minutes.
It was a good time. I was very happy with the time, but a great experience.
So I guess once you've swum the English Channel, what comes after that?
Well, you come back to Australia and appear on Your Money, Your Call with Margaret Lomas.
That's it.
That's it.
From high to high.
No, well, look, there's plenty of other good swims, big swims to do in the world, and I'm certainly keen on doing those.
Now, meanwhile, Michael, I know that one of the reasons you did it, apart from that personal euphoria that you can get, was for the Black Dog Institute that you're raising funds for?
Yes, Black Dog and also Lifeline.
Okay. And so how do we go about donating to those causes for you?
People, Margaret, can go to my website, michaelteys.com, which is my personal site, and there you can see the story of my my swim. There's a short video, and it would be terrific if some really wealthy property investors could support the charity. Lifeline gets a call every 36 seconds from somebody in need of help, and they can't answer all their calls at the moment. So trying to raise some money to help with the prevention of suicide.
Okay, excellent. Well, it's a great cause, and thank you for undertaking that swim on behalf of Lifeline and, of course, yourself. And I'm eagerly awaiting. I particularly enjoyed your blogs along the way in the countdown to swimming the Channel.
And a book is coming. I'm writing a book about
Great, excellent,
it. So,
good. I always like to see a book, and we'll certainly all be on that. Brad, let's have a look at our top stories tonight and talking about interest rate cuts. One of the things that I was actually tweeting the other day is that when finally fixed rates get below relative rental yield, which I think I've only seen happen once in my investing lifetime. But when they hit that mark, which is equal to or below relative rental yield, those investors who really like the idea of certainty, it's probably a good time for them to take a fixed rate.
Yeah, and look, fixed versus variable rates, I've only ever fixed a couple in, and I got burnt. And I think most studies that when they do comparison between, you find that the variable rate guys are generally the winner. However, in this situation, I was only having this discussion as soon as this started happening, with quite a few guys in the office especially going, I've really got to consider locking some in, because you can't go too much lower, and you are below that yield. And the certainty and the taking away of such a lot of the risk of investing in property, you can't expect them to go too much lower, especially on, you know, some of them are really low at best part of 5 years fixed in. You've really got to consider that as a serious safety net for your investing. And I'll probably need to do some of that myself.
Yeah. Michael, I was just doing a couple of little figures, and if we said that you were able to get a fixed rate of in the high fours, say 4.9, by the time you factor in your tax deduction on that, which essentially brings the interest rate down to 3.6. And if you were to get a 5 to 6% rental yield, then not only do you have cover on all of your expenses, but it's going to create a positive cash flow for you.
Yeah,
it is a good way to buy a bit of insurance.
It is, and look, I think people like Brad, I've been burnt too on fixed interest rates, but it's generally when the rates are rising and people fix in as a defensive strategy rather than as a opportunity, which I suppose we now see in the market. So, yeah, look, it's a compelling case.
Yeah, it's absolutely compelling. Well, look, let's go to the email, and Joe is looking to Melbourne to invest, and he asks, I've been looking at investing in some apartments in Melbourne. There are a few in the city and also in Carlton. Most are student accommodation. The returns are between 8 to 10%. This is great, but I'm not sure about the prospect of capital growth. Surely they must grow in the future. What do you and the panel think? Michael, I guess in this one email there's two concerns I have.
There's lots of questions. there's lots of issues.
Two main concerns I have, and you know what I'm going to say here. I'm concerned about what's essentially inner city or close to inner city Melbourne, and then I get concerned about niche market property of a student variety.
Yeah, and look, student accommodation, generally speaking, does provide higher yields, but there's a reason for that, and that's because it behaves more like commercial property than it does residential property. In fact, some of the student accommodation is built in a way that can't be used for residential property as an alternative. So the banks will look at that, the valuers will look at that, and investors should look at that as well. But there were some interesting studies around and reported in the Fin Review today about the uncompetitiveness of the Australian education market, particularly when you take into account living expenses. So the Asian market is now looking towards America. America's looking very competitive. And it's one of those examples where when you do invest in the niche market, you really are taking on the business risk. You know, we've now had deregulation of universities, or we're about to see, the funding change radically. Well, that becomes a risk if you're an investor in that property. Where residential property, it's about where people sleep.
Brad, I guess apart from the fact that the biggest issue with student accommodation is because they are purpose-built, they normally don't have a second end use. If you struggle to get a student, you often can't turn them into something else. But apart from that, students as tenants in their own right can create issues.
And I guess,
you were one.
I didn't create too many issues, I don't think, for my landlords, but I think a couple of big cons are right there, and you hit one on the head definitely, where you're relying on a market in an area that relies on something that's students, but students as tenants, as much as I was a student, tend to party more. They haven't lived out of home. They don't really understand what it's like to look after a property, and they're not thinking about the future ability for them to be accepted as a tenant in the next property, I suppose, a lot of the time. So that's always definitely a risk with something like a student accommodation, and you're limiting your potential buyers. Like anything that's got some sort of attachment, being it guaranteed rental or a travel or accommodation in some ways limits who you've got the potential to sell that property to, which is always going to damage the potential for capital growth, I think.
And look, to that, what I'd like to add is the fact that at the moment in those surrounds around the Melbourne CBD, Docklands, Carlton, those areas where we're seeing a lot of build, we are facing a fair amount of oversupply. Now, there's no question that there is a trend toward inner city apartment living again. That's been proven from the studies. But what's also been proven is that the oversupply is still outstripping the increasing demand. There's a slightly creeping demand, but there's a massively creeping supply of apartments that are going to take many, many years to work their way out. So on top of the fact that very often student accommodation doesn't grow well, in addition to that, then if you're also buying in an area where there's an oversupply, then it doesn't grow well either, because there are just too many of the same thing. So my advice to you is, if you are an investor who can embrace risk and is happy to take on that risk, if you're not relying or putting all of your eggs into this one basket and really relying on this to work, then go for it. It could be a risk worth taking. If, on the other hand, you're an investor who it has to make every single one count, if you can't afford to lose, if you also are buying property one at a time and you need each one to grow in order to leverage into the next, then you probably need to look at a more opportune market where you can prove that there's plenty of demand, not too much supply. We've got a good family demographic, plenty of infrastructure planning, and lots of those other things happening along the way. Well, it's great to have you tuning in again this week, and for the first time, and for first-time viewers, welcome. This week, as usual, we're continuing with our question of the week, and this is your chance to get hold of a copy of my brand new book. Now, it's called How to Achieve Property Success, and it's the combination of my first 3 books, the complete guide to buying property, and covers everything that you must know, from tax and gearing right through to finance and conveyancing. All you have to do is call us on 1300 30 3435 or email property@skynews.com.au with a question, and then make sure you watch at the end of the show to see if we choose you. We're taking a break, but stay tuned. There's plenty more to get through this week. I'll see you soon. Welcome back. I'm Margaret Lomas, and this is the property edition of Your Money, Your Call. Now, this week we welcome back Michael Teys from Teys and Brad Beer from BMT. They're here especially to answer your questions. So pick up your phone and call us now on 1300 30 3435, or of course you can email us on property@skynews.com.au. And Anne, you're from the Central Coast. Anne.
Hello.
Welcome to the program.
Thank you very much.
You've got some questions about Queensland, I believe.
Yes, we're currently looking in the area of Logan Lee, Marsden, possibly Meadowbrook. I've been looking at sort of flood mapping and that sort of thing, and I'm just wondering whether you know much about that area. There seems to be a fair bit of land still available, but whether they're able to build on it or not because of the flooding.
Yes.
I'm finding it very difficult to get information out of council, because I know their zoning is also changing at the end of the year.
That's correct. And you also had a second question about depreciation reports.
Yes, I was just wondering with BMT, do they do depreciation reports all around the country, and how I would best source someone to do my depreciation report, solicitors, that sort of thing, in another state?
Okay, excellent. We won't think that she's a plant calling Brad
I don't know
for you. But we'll go to the first question first. And of course, you know, if you watch this show or even Property Success, you'll know that it's a favourite area of ours at the moment around the Logan Shire. And Michael, you're from, not from that area, but you're from Brisbane originally. And you're
from
indeed
that area.
Okay, from that area.
Born in Beenleigh.
Oh, born in Beenleigh. The boy from Beenleigh. That's
exactly.
Excellent.
Yeah. Look, it's a solid area, isn't it, Margaret? It's been a solid area for a while for investors, and it continues to benefit from the growth of both Brisbane and the Gold Coast, and it's now a city in its own right. So it's a good area for investors, and I think it has been for a long time. I can't help with the change to the town plan there. I'm not across that, but in fundamental terms, it's a great investment.
Absolutely.
One of the best roads in Australia, I think.
Yes, I agree entirely. And Brad, just a word on depreciation reports before I head off to talk about Logan.
Look, obviously, yes, we cover that area. We cover nationally. We've got staff and guys. There's 190 of us. We're spread all over the country, so there's no problem with that. And websites, bmtqs.com.au. You can find us fairly easily, or me. And look, every bit of positive behind Logan in that area. I've got property there. I'd invest there again, so no issues with that area.
Absolutely. Look, it is a favourite area of mine at the moment because it has a very, very solid family demographic, and the change to the town plan includes some more medium density dwellings, which means that the council has an expectation that eventually, or in the near foreseeable future, that land in many of those areas is going to run out, so they need to have that infill development going on there. There's a lot of foreign investment in commercial properties or commercial ventures in Logan as well. Lots of Chinese investment going into the area, and a council that's very committed to seeing that area grow and prosper, and also to slightly change the viewpoint that people have about the area. It has some uncharitable names given to it, but certainly we're seeing a changing socio-economic situation occurring there and changing demographics too. I'd be inclined to look around the areas of Crestmead, Kingston. Some of those areas are quite high and dry, and you don't have that issue as far as the flooding goes, and you also don't have that issue with the oversupply of land. Kingston still has some land left, Crestmead not so much. You can come in behind a lot of those people who purchased property in those areas and overpaid and are now having to sell off, just as you can in Redbank Plains and some of the areas around there as well. So there's plenty of opportunity in and around Logan Lee, but I'd be inclined to look at Crestmead, Kingston, maybe Eden's Landing, and those areas first and foremost as leading the charge in that area. Michael, you're also from Brisbane. How can we help you?
All right, Margaret, thanks for taking my call. You've mentioned Morayfield in the past as a place to invest, but I've just noticed recently that maybe Caboolture is offering better rental yields. I just wondered on your thoughts if the same drivers would still apply to Caboolture, considering it's the suburb right next door, maybe even South Caboolture, that's even closer.
Michael, with regard to Caboolture, there's a couple of things that have happened up there. Of course, it's a big university precinct, and something like 27% of the population are actually enrolled in one of the educational institutions in Caboolture. So there's a younger demographic there now. Used to be an older demographic, a retirement area. Younger demographic now. A lot of new land coming on the market, but very, very low buy-in prices and good rental yields.
I like Caboolture.
Yeah.
I like Caboolture. Excuse me, I had a retirement village there myself, which I developed and owned and had there for a long time. I think Caboolture's very good. Low entry price, appealing, good access to the airport, so it's a favourite of mine.
Excellent. Brad, any comments on Caboolture?
And look, Caboolture versus Morayfield, not necessarily, but Caboolture, I think, has probably had a bit of its hurt. There was probably a bit of oversupply of house and land package type product that maybe wasn't right for the area, sold in at probably higher prices, and it's probably been through that, I would suggest. So I don't have negatives towards it.
Some would think that Caboolture is probably at the bottom now and about to turn around. I think there's a good long-term prospect for Caboolture, and it's interesting because if you watch Property Success, not this Saturday but next Saturday, we're actually spotlighting Caboolture, Michael, so you can pick up that town spotlight and see what we found up there. But one of the things that I believe will happen with Caboolture is I think it's probably slightly more long-term than Morayfield, which is still captured in that whole Moreton Bay Shire and closer down to Kalanga. But Caboolture had a lot of interest about 5 years ago, and it did tend to get a little hot for its area. I also think that Deception Bay and the areas around there are not Runcorn,
Redcliffe.
But it's not Redcliffe. It's another. It's just in from
Redbank Plains.
No, just in from Deception Bay. Anyway, the next suburb over for Deception Bay, I know it well, but just can't put my finger on it, which I will throughout the show, I'm sure. I think they'll go first, and then I think once they've had a really good growth, we'll see Caboolture again. It's certainly one to hang on to and to buy in now while it's still low, and hang on to if you don't need to get that immediate growth in the next year or two. I don't think it will get that in the next year or two, but I think it will certainly come within about a 5-year period. We're taking another break, but call while we're gone with your question, and you might get a copy of my book, How to Achieve Property Success, if we read out your question and then select you. The number is 1300 30 34 35, or the email address is property@skynews.com.au. Don't go away. I'm glad you stayed with us for this week's instalment of Your Money, Your Call. I'm lucky this week to have two of the best, Michael Teys from Teys and Brad Beer from BMT, taking your calls. To speak to any of us, call us now on 1300 30 34 35 to join the queue, or you can email us on property@skynews.com.au. Now, with Michael on the show tonight, I thought it was great to have a chance to answer Hannah's question, and she says, I recently purchased a unit in a block of 3. The property was freshly painted at auction and was leased within a week from settlement. I'm experiencing water egress that is damaging walls and carpets inside my unit. According to the plumbers, that's caused by a poor flashing and gutters on the common walls between my unit and the adjacent unit. Body corporate don't have a sinking fund, and I'm having problems getting the works completed as other owners are not willing to spend the money. What should I be doing now? Michael, before you answer that question, this is a horrible situation that a lot of people find themselves in for a number of reasons. Often they fail to get a body corporate search done prior to settling, where they would discover that either there's no sinking fund or one with not enough money in it. And secondly, I think when people go into these things, they probably skimp on the building inspection, so they probably get one of the cheapy tick box ones, and really with strata titles, you've got to pay the bigger money and get a good one, because they all leak. And I think people just don't really understand strata living.
They don't understand strata living, but your point about the search report is really important. A good search report is essential for anyone that's going to live in an apartment or own it as an investor, and it will tell you the sinking fund is free money. When you buy a unit, you get a share of the sinking fund. It's really important to the investment proposition, and it can and it should be significant. So it's a shame that they don't have a sinking fund, but the owners can't shirk their responsibilities. They must strike a levy to repair and to pay for this damage, and that's their obligation. This water is coming through the common property, and therefore it is a body corporate or an owner's corporation's expense. And if they won't do that, then you can take action in New South Wales. That's in the NCAT, the New South Wales Civil and Administrative Tribunal. First, you'll have to go to mediation at the Department of Fair Trading. Go to the Department of Fair Trading website. There's a really good guide there about how to do that. You don't need a lawyer. You can take one if you want, but you can. It's an informal process, but they need to be brought to account and understand that when you own and you share walls, floors and ceilings, there is a responsibility to each other to make sure that they're repaired and maintained correctly.
I'm also thinking that it's very likely that this particular property mustn't have a strata manager or a good one employed, because if they did, I can't see them not having a sinking fund and all of those other things that are a real requirement in there.
They are a requirement. In most states and territories around Australia, it is a requirement to have a forecast, but it's not always a requirement to actually fund the sinking fund in accordance with the forecast. So some people succumb to the pressure of keeping levies down. And sometimes we can't keep levies down. Sometimes property needs, or all the time, property needs things spent on it. And the owners of today have to pay for the property that they're using today and to progressively save for the repair and maintenance of these items.
And Brad, just quickly, are you...
Yeah, look, having prepared in the past, and we don't actually do them anymore, sinking fund forecasts as a quantity surveyor, we estimate and allow to make sure there's enough money in those sinking funds to fix. But we always found this common problem of people not wanting to pay towards that sinking fund as much as really as need to be kept. So you want to, check what the sinking fund forecast actually looks like. It's been done by someone who knows how to estimate what you need to put aside. It was always a difficult argy-bargy that we had to play where they want to take everything out.
Yeah. Well, look, certainly a lesson for you, and make sure that you go to NCAT or VCAT or QCAT or whatever state you're in. Go to the CAT where you are to make sure that you get some really good quality advice, and you need to follow that one through. It's great to have your company tonight. We're headed off for a short break, but when we return, you'll have another chance to get hold of a copy of my brand new book, How to Achieve Property Success, but you'll have to ask a question and have it selected. Just call us now on 1300 30 34 35 or email us on property@skynews.com.au. Thank you for still being here. I'm Margaret Lomas, and I always love having Michael Teys from Teys and Brad Beer from BMT on the show. And I'm sure that you do too. Now, there's plenty of time left for your questions, so give us a call on 1300 30 34 35 or email us on property@skynews.com.au. Gary from Melbourne, welcome to the program, Gary.
Thank you, thank you.
Your question's about Queensland.
Look, it is. I decided 2 years ago I thought I'd invest outside.
Oh. I think we've just had Gary drop out. Gary, you back? Hi, Gary. No? Gary? Hello? Okay, look, we'll try and get Gary back, but I understand that his question is about Rockhampton, and from the beginning of that, I'd suggest that he's saying that he decided to invest in Rockhampton and nothing's happened. You're back, Gary?
I can hear you.
Excellent. Okay, so you invested 2 years ago in Rockhampton, is that correct?
That's right. So for me, it was the first time outside a major metropolitan city. I was thinking of mining town, and when I read a bit more about it, I got nervous about the size of the investment in Western Australia. I focused on Queensland, and I ended up looking at Gladstone and Rockhampton. Rockhampton was sort of half the entry price and seemed to have good fundamentals. But in 2 years, the interesting thing I suppose happened is that there's probably been 3 tenants in the property, and rent went from $300 to $330 to now $260 just to get a tenant in there. So whilst I'm not panicking or overly nervous, I was probably more just interested in your view on that market and what might be happening in Rockhampton.
Yes, yes. And look, Brad, probably not necessarily a bad idea not to go with the ones up in far north Western Australia. They're certainly already teetering on the verge of suffering big time from vacancies, with all the big mining companies now getting their own miners' accommodation and fly out workers and not needing so much of accommodation up there. It is a bit dangerous to get those big ticket $1 million items and
Yeah, I think on that really high cost stuff, your risk is just much higher. If it's one of a number of properties and it's one you're prepared to take some sort of punt on, but it just becomes it's a large number punt, which is always a little bit scary. And I've seen, like, we do a lot of depreciation schedules in mining areas, and we've seen guys, and you have a discussion with them sometimes, and they've bought it for some reasonably high price, and they're getting these massive returns, and I sometimes nearly get sucked into that concept. But then I was speaking to one a couple of weeks ago who had it in one of those type of areas and couldn't rent it to save themselves. It was $1,500, and now they can't give it away for $150 bucks a week.
Sounds like Moranbah to me.
It was in Queensland, that one.
Yeah,
I can't remember
it would
the
be
suburb where it
Moranbah,
was,
I'd
but,
say, yeah.
And so you've got that both ways.
Yeah.
But I think your 300 to 330s, that's good, a little bit of rise, but then back to 260s, a little bit of hurt. It's not back to zero, and it's really about, I suppose, thinking about your property and the future of Rockhampton. We'll let Margaret talk about it a little bit, but can you hold, and what is the opportunity cost of you holding that property? And maybe you've got to consider looking at, if you do get out, what are the costs of getting out? And if you think there's somewhere better to think about, then if you can't buy elsewhere and that's hurting you from doing that, that's the one time I think, the concept of selling is really something up your alley. I've got things that I've probably held that haven't performed, that haven't been performing, but I've also been able to hold them because they're not stopping me from investing elsewhere. Some of them, hindsight, I'd like to not have bought or still sell now, but they're not hurting enough for that to be a big problem for me.
Michael, I've still got a little bit of faith in Rockhampton. We've got beef, we've got its proximity to Gladstone, which is a little up and down, but Gladstone is more than just a mining town, being the third largest, about to become the second largest port in Australia. I don't think it's ever going to break any records, but I also think it may have some bright future this year, with Queensland looking a little hotter. Well,
Queensland looks good, but look, Rockhampton is just a bit lacklustre, I think. I can't articulate a plan for Rockhampton where you sort of hear it. You read a lot about Gladstone and understand that around the ports. Rockhampton, to me, just is a country town servicing the rural industry, and I think it needs a bit more than that before it starts attracting investors. Going in because it's very low is not always just a great strategy by itself, and maybe the fundamentals weren't right when that investor made that call. but I think it's certainly to be careful about, I think.
Look, Gary, I think that you'll probably get some short-term growth there out of investor sentiment, because it is a fairly cheap market and it does offer, even though you're seeing a lower rent return, it offers a fairly good rent return of about 5 to 6%. And there's a lot of interest coming into Queensland, and everyone's picking Queensland as being the next hotspot. And certainly the economics are showing that for the first year in a long time, we've seen some significant economic growth in all of Queensland. Queensland's been in economic decline for a couple of years, and it's returning to that economic growth now. We're going to see some of those larger regional areas where we've got a little bit of mining influence, where we're going to see the cattle and that kind of thing push them along a little bit. For the long term, I don't think it's going to go on and keep growing, which is really what you want to see happen and what you're going to get if you can invest somewhere else. That doesn't mean that you can't get that kind of long-term growth in a regional area. You certainly can. There are regional areas that do provide it, but typically we see it in those outer suburbs of the capital cities. And so, as Brad said, it depends on whether this is holding you back. If you haven't used up your equity, then I'd be inclined to sit with it and buy some more property on top of that and wait till it does a little bit more. If it's preventing you and becoming an opportunity cost getting in somewhere else, it could be a good time to wait over the next 6 months when there'll be a bit more interest, and then maybe you'll even make a little bit of a profit out of selling it, and then maybe invest in a different market from there. Nathan from Sydney, how can we help you, Nathan?
Oh, hi, hello all. My question is just in relation to having a last right or an option over a property. If I'd identified a property that I was interested in but wasn't in a position to buy it in the interim or straight away, could I agree with the vendor for some consideration, so obviously giving them some money in lieu, to be able to have a last right, or once they've agreed a price with someone else, so I can come in at the last minute and have the ability to offer more money and then purchase the property from someone else?
Okay, that's an interesting way to approach a property option, Michael. Property options are becoming a little more common. The difficult part with property options is finding a vendor who'll accept one, because usually with a property option you pay a small percentage of the final contract price to take the option, and then you've got the option but not the obligation to purchase that property at an agreed future time, and all of the upside sits with the buyer really, because they can just ditch the whole argument and walk away, and all the seller gets is the little bit of the option money. But I think what's being discussed here is actually saying, well, if you decide to sell and someone else is going to buy it, I get the option to actually gazump them and outbid them.
Yeah, there's the adage about options is always take them, never give them. So take it if you can, but you've got to ask the question, why is the option being offered? What is the vendor? Well, it doesn't seem to me to be a sound commercial proposition for the vendor, and you'd wonder if the vendor is prepared to give an option, whether or not there's something wrong with the property, whether it's a difficult property to get rid of. It doesn't seem to me to be, it seems to me to be a very complicated transaction, and I'd want to understand the reasons for that.
Brad?
Now, I haven't bought anything under option, but in my time, and I think as a vendor, either there's one of two things I think that exist, and one is potentially there's potentially something that's concerning about the property. Otherwise, as a vendor, considering the upside is not there for me, I want a premium for the property in some way. I want some reason to sign this option instead of being able to sell it as under a normal contract. Now, so either something wrong with the property, the fact that you pay a premium, and then if you're going to pay a premium, there's got to be something really good in there. Is it a developable site, for example, and a developer trying to option you up to get it subject to, then as the vendor, you still, got a little bit of a problem with the fact that you've got no recourse if it doesn't go ahead. So as the buyer, you're paying more. Unless there's enough upside, trying to do it under options is a bit scary.
Michael, I think what we're talking about here is actually designing that option a little differently, so that he just waits until someone else eventually offers and then comes in above them. Now, I'm thinking that there's going to be some states where that's going to be actually against the law as well.
I'm not aware of it being against the law. It's just odd. Those sorts of first and last rights are very, very messy. And sometimes you see it happen in commercial property where it'll be built into a lease, and there's always a fight about whether or not the property's been offered on exactly the same terms and conditions. It's always a fight. So it's just an area that is just prone to litigation and difficulties. Sometimes people will use an option when they're running a development to underwrite some sales. So it can be used effectively in that type of market. But there, I think the caller said he couldn't afford the property at the moment, so was going to take an option. If you're going to be taking options in a property development, there'll be a call option where you will have an obligation, so you need to be careful there.
Yeah, and I'm just worried about that side of it, the obligation side of it, because it's not a contract or an option at all unless it's got something in there that is going to lock someone in. I think it would be unlikely, and you're going to have to pay money for this. I mean, if I was the vendor, I would just go, yeah, I'll take your money for that contract, and then you can have a good go at beating the next person, but if you can't, then it's no skin off my nose. I get to sell the property anyway. I think getting someone to agree to the other side of that option is going to be
very hard.
Difficult, and I think actually getting that option to watertight so that the vendor doesn't just turn around and go, well, I've changed my mind, is also going to be the difficult side of it as well. Not to mention the fact that in some states, just be careful, because in some states like Western Australia, once an offer's on the table and accepted by the vendor, then they can't go and sell it to someone else. An offer and acceptance is actually binding contract in Western Australia. So you could have that situation in at least that state. So, well, we're having a great time here, but we do need to take another break. Call us while we're away with a question or maybe just a comment. Our number is 1330 34 35, or you can email me at property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Margaret Lomas, and joining me tonight on the show is Michael Teys from Teys and Brad Beer from BMT. Now, if you have a question, call us now on 1300 30 34 35 or email us on property@skynews.com.au. Luke from Melbourne, welcome to the program, Luke.
Yeah, hi Margaret, thanks for having me on.
You're welcome. What can we do for you, Luke?
So I've got two questions actually. I've owned an apartment for about 4 years now, which I lived in it for the first 3 years.
Yes.
12 months ago I moved overseas, and look, the apartment only cost me a few $1,000s a year to hold it, but to be honest, look, I need to get a bit of extra cash flow happening living overseas. I've got two questions. A, can I borrow against the equity for a cash loan? And B, if I was to sell, am I still subject to capital gains even though it was mostly a place of residence?
Okay, I have a question to ask you, if I may, Luke.
I'll try, yeah.
When you bought that property, did you buy it with the intention to move in, and did you move in straight away?
Yes.
Okay. Okay, so I have answered that question, and I can answer all of the question if no one else would like to have that. Brad? I'm happy to go with that.
Look, capital gains tax, it's your principal place of residence. You've got up to, I think it's 7 years before you're going to have an issue, as long as you haven't obtained another principal place of residence. So there shouldn't be any problem with you being able to get through that without a capital gains tax issue, providing there's nothing else we don't know about there, most definitely.
Okay.
You're overseas. Do you want to go with that one, Margaret?
Yeah, no, that's good. I might just jump right in there. 6 year is the rule. It's the 6 year rule, and providing when you first purchased that property, you bought it with the intention to live in it, and in fact you moved in as soon as it was practical after you settled, and it was your own home, you have a period of up to 6 years to be able to move out, and you can even rent out that property and claim all the deductions and do everything you like, and as long as you either move back in or sell within that 6 years, not 1 day later, then you will have no capital gains tax to pay whatsoever on that property. Now, it's important to also know that you can move back in, and providing your intention is to once again live there, and then if things change and you move out again, then you trigger another set of 6 years. And you can do that as many times as you like, so long as you're not seen to be buying an investment property that you live in for a bit and then move out and rent, and then you move back in for a couple of days just to try and trigger that other 6 years. If your intention is for it to be your own home and you don't have another principal place of residence exemption elsewhere, so you can't be claiming that exemption on a different property at the same time, then you've got that 6 years. Now, the second part of your question is about the cash loan. Can you set up a cash loan against the equity? Sure you can, providing you qualify for a loan and the bank is happy to give you the money, and providing you have enough equity there, you can borrow up to 80 and 90 to 95% with lender's mortgage insurance against your own home. And if there's any difference between what the loan was and what you can now borrow, that can become a cash loan that you can take the cash out of and use for anything you like. The crucial point comes here. If you are renting out that property still and claiming a deduction on the interest, you can't claim a deduction on the portion of the interest that relates to that cash loan unless you use that cash loan to buy another property that was income producing. So, but just be careful if you decide to do that. You structure it in such a way that you quarantine any personal use funds away from the funds that are currently related to the property, so you don't mess up all your tax deductibility there. Before you do any of that, I always recommend that someone gets some good advice from their accountant to make sure that they're not jumping into more hot water by making decisions and going and taking action without checking on all your deductibility status first. Let's look at a question on strata levies from Robbie. And Robbie says, I live in a strata complex. My unit is a garden unit, so I pay more strata levies than the rest. I feel that my portion of the levies is unfair, as I pay more for the lift expenses, more for the insurance, more for the strata management fees, etc. I don't use these things any more or any less than the other unit owners. Is there any fairer system of paying a more equitable portion? I would like to know that too, Michael, because
well, the short answer is no.
I live in a unit where I have to pay, there's 4 and I'm paying 32% or something.
I think that's fair.
I don't think that's fair.
Levies are paid according to lot entitlements or unit entitlements. So when you buy in, and again this is another reason why people need to do a proper search when they buy in, to understand how much of the expenses you're going to have to pay relative to your co-owners. Now they're set by developers when the building is built, and they're cast in stone. So it's very important that you understand what your share is. It's virtually impossible to alter that. You can make application in the event of fraud, or if there's been a serious injustice where the developer perhaps has kept the penthouse unit for themselves and given themselves one entitlement and given someone else 100. So where there's a very obvious fraud, and they happen from time to time, then you can take action. But if you just think it's unfair, you're not going to be successful, because when you pay less, of course someone else has to pay more. So Queensland has been notoriously plagued by these problems where they did experiment with an adjustment formula, and it has just been an absolute disaster. So it's one of those things where you really need to look at the entitlements. It is something that you just can't change. You have to be able to live with it when you purchase, and so good luck with your fellow owners. But unless you can come to a unanimous agreement, which hardly ever happens in strata, I'm flat out getting people to agree what day of the week it is when we have a meeting, let alone trying to adjust these proportions.
Yeah, and look at it.
Especially when they've got to agree to actually paying more money themselves.
Well, that's right, yeah.
But I've got some good news that Brad can support here. It does seem unfair that you're paying more when, in fact, if there was 4 units in a block, it seems to make more sense that you split everything 4 ways, because the common property you all use the same amount of time. However, what Brad will support here is that if you have a higher entitlement amount, you get a greater proportion of the tax deductions on the depreciation on the common property, Brad.
Yeah, look, so you always own your portion of that lift, your portion of all those common areas, and whether they fall into building allowance or plant and equipment deductions, you own more of them, so you get to depreciate more of them, so you get more deductions out of that at least. So a little bit of a consolation there.
Which is often missed by investors in strata property, isn't it? Often
I see
missed.
I see that all the time. You've definitely got to go through the strata and get the common areas, and sometimes it's an easy way to pick up. Say, if you've done it properly, no, you haven't.
Absolutely.
Haven't picked up these
and
things.
It can be a really big upside to you, because the more stuff you've got on the common ground, like the more lifts and pools and all that kind of thing, you're getting a bigger proportion of those to call your very own, and therefore to depreciate. And on-paper deductions bring cash back without paying cash out. So explore that one. give them a call at BMT.
And look, in the common areas, there's a couple of different rules with the percentage of ownership that mean you can claim it really quickly as well, which also means more deductions quite often.
Excellent. Not a lot of time left, but there is some. If you do have a question while we head off for a break, you should phone it in on 1300 30 34 35, or you can also email us on property@skynews.com.au. We'll be right back. Welcome back to Your Money, Your Call. I'm Margaret Lomas, and it's been a great night with my expert panel, Michael Teys from Teys and Brad Beer from BMT. We have no more time left for any more questions, so instead we'd like to talk about an article that was in the Fin Review today, Michael, about spruikers. Finally, there may be a little bit of action happening.
The Financial Review ran an editorial piece on it today, which was really interesting because it's so, it's generally not got the attention of the major financial press, and it was really exposing the crack we have in our laws, where it just falls between a security interest regulated by ASIC and real estate interest regulated by state real estate authorities. And it's something that, it's been a problem, particularly where people are being brought into seminars and then being upsold into more expensive seminars and other products. So it's interesting to see the Fin do something about it, and hopefully that helps our campaign.
Yep, and the Department of Fair Trading, or Departments of Fair Trading all over Australia, are all onto it at the moment, so hopefully that will bring about a slightly better regulation for all of us. Well, that brings us to the end of our show. Make sure you join us again next week, and if you have a question for me, send it to me before then so that we can make sure that we get to it. Thank you to my guests, Michael Teys from Teys and Brad Beer from BMT, who will of course be back again very soon. Thanks also to all of our callers. Now, this week our question of the week goes to Anne from the Central Coast. Anne, you asked a question about investing in Loganshire. If you can now email me on yourmoneyyourcall@destiny.com.au, that's yourmoneyyourcall@destiny.com.au, I'll send you a copy of my brand new book, How to Achieve Property Success. Now, if you missed out, you can get the new book from my online store at destiny.com.au. It's at a special price for a little while, so jump on now. It's a great book and a must-have for every property investor, but you can also get it from all good bookstores. And finally, if you're a Perth viewer, I'm personally conducting one of our fabulous essential property education courses on 6 and 7 September, and with only 24 places in total, you need to get in fast. Go to my website for the details and the phone numbers. Thanks for being with us, and I'll see you all again next week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.